Yo, what's up, guys? How's it going? Welcome back to my YouTube channel. Today, we are going to be going through my new and improved strategy. Yeah, new and improved strategy. Right. I changed a couple of things about my previous strategy. This is one of the trades I took this week using my new strategy. So as you know, my previous strategy, right? If we find 9 a.m., here we go. Right, we'll mark out 10 and 11. There you go. And then if we go on the hour time frame, here we go. Here. Right, before we would find 9 a.m. high, 9 a.m. low, and then we'd just mark it out correctly. Shut up. 9 a.m. low. Right, we've got 9 a.m. high, 9 a.m. low. And then we go on the 1 minute time frame. Right, here we go. And then we would quite simply take out 9 a.m. low. So we'd wait till 10 a.m. We'll take out 10 a.m. low or 10 a.m. high, and then we'll wait for a trade to go up like this. So let's see, can we find a trade in this? Let's have a look. Let's just say we took this one here, right? This fair value gap here stops below the low. Excuse me, sorry. And then we target 9 a.m. high, which is a 1 to 3. But as you can see, price just doesn't really do that much. Do you want to know why? 9 a.m. high, 9 a.m. low isn't a key liquidity level. That is why I changed my strategy. That's the only thing I changed my strategy. So this would be a loss. I would go up, take this sort of profit here, and then I'd come back down and it'd be a loss. Plus, it's a very long trading day. So what have I done instead? Right. So here, right? This was the trade I took this week, was it? Yes, this week. So we mark out London high, London low. Okay, I'll get to why I chose London high and London low. Right? Then we wait for a market structure shift, which we got here. So we took out London high. Then we came down, right? We got a change of character here, push down. We created a fair value gap here. Tiny little one here. There's again a small one here, and I think no, it's not fair value gap here. Right, okay. So we wait for price to push into the fair value gap, which it did here, and respect it, which it did. It respected it here. And then price continued lower, hit my full TP. Right. Don't get me wrong, there are days such as today. If we go to today's price action, one of the reasons I didn't stream is because of this. Right. There you go. Right, so obviously market opens at, whoa, here we go here, sorry, my bad. Market opens 9:30 a.m. Eastern Standard Time here, right? We already took out London low down here, basically as soon as market opened, we took out that, and then we took out London low, and then straight away price just reversed, came straight back up and took out London high, which obviously means that we don't take a trade because we trade from, it would usually be from one side to the other, right? So yeah, basically that's what we do. So we take out London low, we look to long towards London high, we take out London high, and we short towards London low. Basically, that's my new strategy. Still keeping everything else the same, entries the same. It's just the what key levels I use. Um, as you can see, we could have shorted and we could have longed, but because we've taken out both liquidity zones in the same sort of span of time, I decided not to. However, we do have, as I said, this example here. This was an actual trade that I took. If you look at my Instagram, my TikTok, my YouTube, it's all there, right? This is a standard 1 to 2 risk to reward trade, okay? So let's have a look what happened, right? So 9:30 a.m., which is here. Don't know why that's not marked out as New York Open. There you go. New York Open here, right? Price came up. We took out London high, basically straight away, right? Price started to push back down, consolidated a bit, then pushed up, right? Pushing back above London high. And then price reversed about 10 a.m. is when it started to reverse. And then it pushed back down, got a change of character. Then we filled the fair value gap here. And then we entered aiming for 1 to 2, right? Why 1 to 2? Right. The past couple of trades that I've taken over the past couple of weeks, I have something like this, right? And I've quite a decent stop loss. And I'd have something like this, right? But price would do this. It'd push about, wouldn't really do a lot, and it would get to a point, and then it would just reverse off a point, usually because there was opposing liquidity, like a fair value gap that was like here. So you'd have like this here, right? There you go. You'd have like a fair value gap here. Price would push into it, then come lower. But I just entered off here because of my strategy, and then because the 9 a.m. high, 9 a.m. low wasn't a key liquidity level. Okay, so we had London high here, and then London low here, and then we also had 9 a.m. high, and then 9 a.m. low, right? Price would take out the bottom of 9 a.m. low, and then reverse up, and we get a market structure shift, fair value gap, and then we'd go long here, target the other side of, it's an awful example, but target the other side of 9 a.m. high, right? Then price would kind of stay around for a bit, hang about, and then price would just down to London low because it wants to take out the key liquidity levels, which are London high and low, Asia high and low, previous day high and low. If you got something like a new week opening gap, that could be a key liquidity level. Previous week high and low, things like that, right? So why would I go for 9 a.m. high and low, right? When it is clear from backtesting and things and just pure market knowledge, right? And price action. It is knowledge, just basic knowledge that London high and low are key liquidity levels, right? So this is 9 a.m. high here, right? So this would have been a day. So 9 a.m. high is here, right? So this would have been a day, no trade. None whatsoever. And this would still be 9 a.m. low. So you got 9 a.m. high here and 9 a.m. low here, right? We didn't take either of them, so it doesn't really make a difference. That would have been a no trade day. But because I switched to London high and low, I'm able to take a trade because these are key liquidity levels. So this here, London high, this is the previous highest that in a London session price went. And then this is the lowest the price went in a London session. And why is that important, right? Well, if you think about it, right, we have money flowing into the markets, right? All the people on Wall Street, all the people on the big hedge funds, big banks, all that, right? They're coming in at 9:30 a.m., right? There could be some earlier, but 9 times out of 10 is 9:30 a.m. where majority of them come in, right? So this is why you tend to see big jumps either up or down, right? Because all this big money, hundreds of millions, if not billions of dollars flowing into the market, right? So where are the key levels where price can take orders, right? Here, didn't mean to do that. And here. This is where the higher likelihood of the big companies of filling their orders, right? Above and below London high and low. Why? Okay. I'll give you a quick 101 masterclass on liquidity, right? So liquidity lies above previous highs and lows, right? You can have internal liquidity, external liquidity. Internal liquidity is things like this, right? This fair value gap that I entered off of. That's internal liquidity. This here is external liquidity because there's no move. Like it hasn't been taken yet. This has been formed within a move. This is outside a move. Okay, so there'll be liquidity up here. There'll be liquidity here, right? So what is that? Just resting orders. That's what it means. Resting orders. That's what liquidity means. There are resting orders above this area here, right? If you think about it, right? People in London session, right, are going, I don't know, long or short, right? Okay. So if we break above this high, right, there'll be buy orders, right? It's people to go long. But there'll also be stop orders, right? Where people will be closing because they've gone short here, right? Above this high here. So you've got two lots of orders, which the big bankers will be able to fill their orders here. So this isn't guaranteed, right? But 9 times out of 10, you will see that price fills orders here, right? So big banks will come in with their very, very large orders. Like, for example, like I'm going in with 11 contracts, right? Big banks and stuff like that, they'll have a much harder time at filling orders, right? Because there is only so many you can buy, right? You need people to sell so you can buy. So when I press buy, there's 11 contracts that I'm buying, right? But that's okay because there's 9 times out of 10 there's going to be 11 in circulation at all times, right? More than 11, maybe a couple hundred, maybe a couple thousand. But these big banks are putting probably hundreds of millions, if not billions of dollars a day into this trade that they take, right? So they want to fill their orders where the higher probability of them all getting filled, which is here, above highs and below lows. So you tend to see the price will push up above a previous session high, like London high here, right? And then it will start to reverse. Why? Because the big banks have filled their orders, okay? Right. So we got quite an aggressive sell-off here. As you can see, we can clearly see that obviously they've filled their orders and pushed price down, okay? So they've got their move. That's what they wanted, okay? No particular reason why they wanted it. They just wanted it. I'm not a hedge fund manager, so I do not know. So we catch the move with it. Why would we trade against what the big banks are doing? Using smart money concepts, you can trade where the money is going, right? So the money's going down, okay? So that's why we use London high and London low rather than 9 a.m. high and low, because this is a higher probability area for price to reverse. Don't get me wrong, there are times where price will sweep London high and then just continue going and we won't take a trade. That's fine. It happens, right? But it's very rare. Very rare. It does happen, but it's rare. So when price takes London high, you'll expect price to reverse. When you take London low, you'll expect price to reverse, but upwards basically. So we'll go from bearish trend to bullish, and then from bullish to bearish, which we did here. Right? I took a trade. I think I didn't take a trade today. I think I took 4 trades this week. No, 3. 3 trades this week. And every single one of them have been winner because I've implemented this strategy, like using London high and low. Then we wait for the market structure shift, which we got here, which you can see as with the indicator I've got is is here. You've got a nice change of character here. When we close below this low here, and then we get a fair value gap here, here, very small one here as well, but we push into this one, respect it, so I enter. Price retests the fair value gap and then continues lower, stopping me, not stopping me out, taking me out for a 1 to 2 risk to reward, right? It's such a easy strategy because there's not like Fibonacci levels where people are like, oh, like this here, like, oh, I should take profit here or take profit there or other things like that. Like people that like this, it's like, what? How do you know where to take profit? I don't know. I don't like it. I like to keep it as methodical and as easy to follow as possible. Something where I can say, this has happened, right next thing. This has happened, right next thing. This has happened. It's something where every single thing has to be hit in order every single time, right? Liquidity sweep, market structure shift, fair value gap, enter. Obviously, depends on context. If price is a bit weak, maybe you'd hold off from taking a trade. If price is strong, then you'd enter. But depends whether there's like just no movement whatsoever. I think there was a trade yesterday. If we have a look, was it here? No. Here, right. I ended up not taking this trade. I was just talking about context, right? We got all this liquidity. Sorry, not liquidity. So we've already taken out London low, right? Which is like down here somewhere, like here. Yeah, this is London. No, it's not. London low's down here anyway. So we're looking to long, okay? So what happens? We get a change of character up here. Okay. Get some consolidation. We get a big move up. We then make a fair value gap. Price then pushes back into it. We get a nice respect, but price is very choppy around this sort of point. I wouldn't have got closed out. Actually, I might have just. I would have probably not stopped about here, so I would have just got stopped out ish. But I chose not to take that trade. I took this trade here with this fair value gap. Even though price was still a bit sloppy, it was still a lot better than maybe other things. So I would enter there, stops below there, target 1, 2, 2, like that. There you go. That was the trade that I took. So just from that, like if I took this one, would I have won? Let's have a look. Stops below here. Okay, well we'll do the first candle first, and then, well, you can already see that I would have got stopped out. One to two. No, I would have got stopped out. Which you can see there. I'm gonna go stopped out there and there again. So it was a good job I waited for that second, this second entry here. It was very close to the end. It was like 10:56. So using context of how the market's moving, how price is moving, you be able to take higher probability setups. But yeah, so the only things I've changed with my new strategy is I only have a target at 1 to 2. A lot of people say, but why? You were making like 1 to 10 or 1 to 5 risk to reward ratio trades and you're making so much. It's just purely based on what I've noticed with price in the past couple of months. This is what I've chosen to do. Yes, I could like push like down to London low, like all the way down here, and take profit there. But I would rather just take a 1 to 2, make it pretty basic, take a win. Boom. Okay. Like, yeah, price could have come up a little bit and then push back down to London low here. And I could have taken the whole trade, but I chose not to. Because that went against my probability, and I know that I've got a higher chance of winning a trade when it's a 1 to 2. Small but consistent wins. Small and what the... Small and consistent wins. That's the only thing that I'm interested in. If you end up not taking a trade like today, it is what it is. It happens, right? So if any of you guys have any questions about why I changed my strategy, um, or what else you think I could add to my strategy, then just leave a comment below. But yeah, market structure shift. Well, first off, we take liquidity as London high and London low. Because why? Again, because they are key forms of liquidity. They are high probability liquidity levels. Brilliant. Nice. Next thing, market structure shift. Change your character, anything like that. Brilliant. Then, third thing, fair value gap. Okay, we enter a fair value gap. We respect it. We close outside of it. Lovely, lovely. What's next? We aim for a 1-to-2 risk to reward ratio with stops outside of the fair value gap. Right. Okay. One more thing to add before I go, right? You look at this level, right? You have a fair value gap here, right? Fair value gap here. You have a tiny fair value gap here, right? If I enter off this fair value gap, is my trade idea disproven? Yeah, disproven if it inverses this fair value gap? No, it's not. Right, so let's say, for example, I went long here. Don't know why I would. Put my stops underneath a fair value gap, which is like about here. And then I am for a 1-to-2, right? Basically a 1-to-2, okay? But if price comes all the way down here, my trade idea is still valid because I could still go long, right? So where would I put my stop? If I ended up here, I mean, it would be a long stop, but I'd put my stop all the way down here, right? And then I would target 1-to-2 up here. Boom. Still will take a profit, so that's good. Being very clean there. So the thing is, right, rule number 1, only put your stops in places where your trade idea is invalidated. So if you, like here, for example, like fair value gap, fair value gap, fair value gap. Okay, if we were short in here, right, and we entered off this one here, we'd put our stops outside of this fair value gap here, and then we'd short for a 1-to-2 there. Yes, it's quite daring because, like, well, why wouldn't you put your stops here so you limit the amount? Okay, even if price comes back up, right? If price comes back up here, right, and pushes into this fair value gap here, right? This fair value gap here, right? Price could still then just reverse straight off it. So your trade idea is still valid. So putting your stops in the ideal place. Don't put it on. So another thing, don't put your stops on the level, right? So like here, don't put your stops here, like on the end of the fair value gap, right? Give it a bit of wiggle room, right? So like here, because 9 times out of 10, price is going to come up to the fair value gap, probably push through it a little bit, and then continue down. If it continues up and it closes here and then pushes above your stop, then yes. But if you have your stops here, right, and then price comes up here, right, pushes into it, then leaves a tiny wick like this, right? Tiny little wick, and then continues lower, then you've been stopped out of on this wick here, even though price has respected it. So if you put your stop loss up here, you'll still be in, right? So let's go over it again. Number 1, London high, London low liquidity sweep, right? If we take out London high, we're looking for shorts. If we take out London low, we're looking for longs, right? Okay. Then what we're looking for, 10 and 11 a.m. Between 10 and 11, right, we are looking for a market structure shift and a fair value gap, right? Once we enter the fair value gap, we respect it in the direction that we want us to go. So if we're looking for longs and then we make a bearish fair value gap, obviously we're not going to enter off a bearish fair value gap to go long. Stupid, right? A bullish fair value gap for longs and a bearish fair value gaps for short. Perfect. Okay. You enter off the fair value gap. Then where do you put your stops, right? you put your stops at the bottom of the fair value gap or the top, like top side. Make sure you leave a little bit of room so your stop loss has a little bit of room to play with. So if price pushes through the fair value gap just a little bit, you're all right. You're safe. Blah. Okay. And if you have multiple fair value gaps stacked on top of each other, aim for the lowest one, right? Perfect. Also, if you've got multiple stacked together, I wouldn't enter off like instinct of the first one. See if price like if it respects it and continues, then yes, enter. If price kind of blows through it and stuff and goes for the other ones, that's fine. You can enter off the first one. It doesn't make a difference. It's basically all one fair value gap. If you've got a fair value gap here, 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 and here, it doesn't invalidate this a whole range until it invalidates this fair value gap here, right? So yeah, stops on the last fair value gap or just the fair value gap that you entered on, and then target 1 to 2 risk to reward basic, right? Once you get a bit more comfortable, you might be able to add a bit more in, maybe trail your stops, things like that. I'm still in the testing period. I'm going to forward test for like 100 to 200 trades, and then we'll see how it goes from there. But at the moment, I am just purely doing 1 to 2 because that's what I've noticed that works for me. I've done 1 to 3, I've done 1 to 4 on like trades on back testing and forward testing this week and stuff like that, and just wanted like this is the 1 to 2 here, right? It's still a pretty big trade. It's a very nice trade. Okay, you just want to make sure that you take the highest probability setups. But yeah, that is a quick overview of my trading strategy. I hope you guys enjoyed it. If you have any questions, as I said before, leave them in the comments below and I'd be more than happy to let you guys know. But yeah, all right, guys. Have fun using this strategy. It's very simple, very easy to use. If you guys do end up using it and taking wins with it, send me a picture of it. Like, send me a message saying like, "Oh, I've won this trade with it and stuff," and I don't know, share it on my story or something. Like, brilliant, great. I want more people to use it and stuff because it's so easy. It's like bro, like some people overcomplicate trading so much. It does not need to be complicated. This is perfect. Like I've got 100% win rate this week. I mean, that's just in 1 week. Just from changing it slightly, I've got 100% win rate. So at the moment, obviously, I'm not going to keep a 100% win rate because it's just not going to happen. But I still have a pretty high win rate just because I'm targeting such low risk to rewards, 1 to 2 basic. So yeah, it just makes it easy. All right, guys. You guys take care of yourself. I'll probably post some more videos going over each individual thing in my strategy, liquidity sweeps, fair value gaps, like how to spot market structure, things like that. All right, guys. You guys take care of yourself. Yeah. Bye.